Nvidia reported earnings last week and the stock jumped again, taking the company's market cap to $2.65 trillion. With $31 billion of cash on the balance sheet and $9.7 billion of debt, the enterprise value is $2.63 trillion. Over the last 12 months, Nvidia has now reported $80 billion of revenue, $43 billion of net income and $39 billion of free cash flow. So the stock is now valued at roughly 33 times revenue and 62 times earnings. This was another strong earnings report from Nvidia. Revenue increased 260%, gross profit quadrupled, and free cash flow grew to $15 billion, a free cash flow margin of about 58%. Ever since the company reported Q1 earnings a year ago, Nvidia has continued to defy expectations. The explosive growth of generative AI and the need for Nvidia's GPUs has produced one of the most consequential stock market rallies in history. The company has added nearly $1.8 trillion in market cap over that time, roughly the same size as one Amazon. Of course, investing is about looking forward, not back, and at 62 times earnings, there are some obvious questions about Nvidia. The first is slowing growth. Starting in the second quarter, Nvidia's growth is going to slow dramatically. Yearly comparisons will now include the huge spike from 1 year ago, giving the company a progressively higher bar to clear. The rate of revenue growth looks set to decline next quarter for the fourth quarter in a row. And the big question is how much longer Amazon, Microsoft, Google, and Meta can continue to ramp orders. A single customer drove 13% of Nvidia's revenue last year, and it's worth considering at what point does that slow down. Nvidia GPUs aren't always going to cost $40,000 a pop, and the hyperscalers aren't going to keep increasing their capital spend forever. A lot depends on the return that these major firms see on their generative AI investments. Based on a reverse discounted cash flow model, Nvidia would likely have to grow its top-line revenue at 30% a year with a free cash flow margin of 40% for another 10 years in order to produce an annualized return of around 13%. That kind of revenue growth is unlikely to come from generative AI alone, so Nvidia likely needs help from other applications. Its automotive segment could become hugely valuable in a world of autonomous vehicles, but currently it makes up less than 2% of sales. More likely, the law of large numbers suggests that Nvidia's growth will have to slow down, and as growth slows down, so will the stock. The best analog is still Cisco, which boomed during the dot-com bubble before posting flat returns over the next 20 years. Cisco saw a huge amount of upfront investment building out the internet, but eventually growth came to a halt, even though the internet changed the world. In the case of Nvidia, I expect momentum will continue and the company will become the most valuable in the world. That's probably another 25 or 30% upside in the stock, at which point the rally is likely to slow down considerably. But these are my personal opinions, not financial advice, and I hold no position in Nvidia stock. For more investing breakdowns, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.